2024 has indeed been a year full of surprises. I must say, after having gone through a series of challenges over the past years in South Africa, it's important to remember that no winter lasts forever and no spring skips its turn. So Reese, you would agree that 2024 has been an interesting year so far, especially with the recent political developments of the Government of National Unity. Your views and outlook on the SA macro in general?
The South African economy grew by 0.6% last year. This was in line with our expectations. Our forecast for growth for this year is 1.2%. And our growth estimates for 2025 and 2026 are 1.3% and 1.6% respectively. There is a possibility of some upside risk to these estimates. With over 3 months of having no load shedding and continued private sector investment in renewable energy projects, our estimates suggest that the economy is increasingly coping better with load shedding, largely because of embedded generating capacity. Our estimates suggest that growth is already about 70 basis points higher than it would have been if we had no embedded generating capacity. So that is the good news. And this is one of the reasons why we see stronger growth into 2025. On the inflation front, we're also seeing inflation averaging the year at 4.9% this year and falling further to 4.4% in 2025. We also see inflation falling below 4.5% momentarily in the first half of next year. Because of subdued food inflation, transport costs falling into deflation, and inflation easing because of high base effects from this year. Importantly for households, inflation across all of the different LSMs from 1 to 10 should see inflation rates coming down for all of the households across the LSM groups, and this should aid consumption, spending and growth. And if inflation comes out in line with our forecasts, we believe that the SARB will have room to cut interest rates towards the end of this year. We think that this easing cycle will be short and shallow, but still we're expecting 50 basis points worth of cuts into the end of this year.
Now, very interesting that you mentioned interest rate cuts and how this should boost consumption. However, it seems like household finances are not in great shape after all. Any color to that?
Yeah. The SARB has hiked interest rates by 475 basis points between 2021 and 2023. So this has had a negative impact on consumers, as you can imagine. Household consumption spending growth has eased quite sharply. Household credit growth has now fallen to a 37-month low, and consumer confidence had been deteriorating. Household finances, like you said, are not in great shape. Debt and debt servicing costs have risen as real disposable incomes have contracted for the last 3 consecutive quarters, impacting consumption spending negatively, particularly in the first quarter of this year. Households have clearly prioritized survival spending, so spending on food, utilities and housing over recreational products because of a decline in employment, depleted savings and slow income growth in general. High inflation as well has negatively impacted households in the first quarter of this year. Now, disposable income growth has not kept up with inflation. And whatever little gains in household net wealth we have seen towards the end of last year was driven by households that have had access to property, interest and other income. Not only that, if you look at nominal disposable incomes that have only risen by 19% since 2018, whereas inflation is up by over 30%. Because of the COVID pandemic, we're seeing this accelerated weakness in the SA consumer base. We've had over 2 million worth of job losses and volatile inflation and interest rates. So we expect the impact of the base effects from the COVID pandemic to have worked itself out of the system by 2025.
Now let's talk a bit about some of the interesting facts you quote around personal income tax trends, GDP growth, and so on.
So tax concentration is quite concentrated among a few employed individuals, but this could ease as higher levels of growth as we project expands the tax base. Although there are currently 16.7 million people employed, the number of individual taxpayers assessed is substantially lower because most employees have either not registered to pay tax, do not file annual tax returns, or more particularly, their earnings fall below the taxable threshold. So in the fiscal year 21, the 2021 tax year, there were just under 6 million people assessed to pay tax, even though there's 16.7 million people employed. And 3 million people only at the very end ended up paying tax or were eligible to pay tax. Of these 3 million individual taxpayers, 2 million people paid 97% of the tax. So the tax concentration is quite high. As the average tax per head has increased quite substantially since 2013, the number of taxpayers assessed also declined. So interesting statistics, but worrying statistics. On the flip side, higher levels of economic growth would likely raise employment, consumption, and reduce the taxpayer concentration in our view.
Now, thank God I'm one of those who pay tax. Now, Riz, I like a bit of an upside surprise, anything that, could be interesting from a population dynamic, social grants, tourism is also picking up and the likes.
Yeah. Fortunately, we have quite a few green shoots on the horizon. In terms of the population dynamics, South Africa's young adult population is currently at its highest on record, about 21.7 million people between the ages of 20 and 39. And research by the Urban Studies shows that a sharp increase in the number of households classified as middle and upper income between 2002 and 2024. There's further growth expected in these LSM groups, in the middle and upper income LSMs, as the young adult population grows and expands. South African birth rates have already dropped and is likely to continue to drop, and growth in the youngest cohort of the population slows. So the under 9 growth has already slowed. The prime working age population, so between 25 and 54 years old, continues to grow, and this means that more households moving upper in the LSM scale, and we have more consumers, more shoppers coming through in the SA economy. In another topic, we've got in the very near term, there should be a pickup in ECD and grade R admissions following the signing into law of the Bela bill, which makes grade R, or 6 years old, compulsory, the school starting age compulsory, from the current grade 1 or 7 years. And then if you look at the 2022 census, found that less than half of the under 6-year-old population attended an ECD or grade R center. So this should increase the school-going attendance. And our estimates that there are around 500 more children likely to be enrolled in grade R upon the implementation of the bill. And this comes at a cost, and comes at a cost of about 17 billion rands. Lastly, in terms of the grants, developments there, the government rolled out the SRT grant during the COVID pandemic, and this has continued to support retail spending, particularly on food and other basic items. The government expects to reduce growth, however, in total household transfers to households over the next few years. Still, grant spending remains quite high. 50% of all households in South Africa receive a grant, 40% of all individuals in South Africa receive a grant, and grants also accounted for about 17% of total retail sales in 2023, and this is up from 14% in 2010. And then in terms of tourist arrivals, now South Africa's tourist arrivals has not recovered to pre-pandemic levels, but there is a recovery underway. 1 million more tourists received into the country should push growth up by about 0.2%. But we need tourist arrivals to go up to the 15 million mark. It's currently at 10 million.
Now, the upside is always music to my ears. Lastly, the big debate and questions around the new two-pot pension reform. Your thoughts and views, is it good or is it bad?
Definitely good on the one hand. If you look at the implementation date of the two-pot pension fund reform is now set for September of this year. We did use tax filer data from SARS to estimate the potential withdrawal risk, the tax windfall, and then the short-term consumption boost. In short, our estimates suggest that if all low-income earners access their savings pot During the first year, this could likely boost consumption spending by 37 billion. So this equates to between 30 and 50 basis points of GDP growth boost between 2024 and 2025. Now, Sean, turning over to you, putting you in the hot seat.
Yeah.
I know you have been quite bullish on the SA food producers for some time, long before most of us could see the light. Is this still the case?
Yes, Riz, indeed. Thank you for that. I think what most people missed with regards to the SA food producers was how lower soft commodity prices provided a much needed relief last year in both wheat and maize. Although we are seeing an increase in maize prices, year to date due to El Nino concerns earlier in the year and some input costs rising. However, I normally like to say, one shouldn't panic. Just like life, there's always something that eventually provides an upside. In this case, it's the positive macro tailwinds you spoke about. You also spoke about lower load shedding, which should provide some recovery, and the continuous work that company management teams demonstrate, with innovation, cost-saving initiatives to help drive earnings.
Obviously, we saw a bit of the market rally post the formation of the Government of National Unity and Cabinet.
Yeah.
Valuation levels, are they still compelling in the food producers or not?
Broadly, the sector, still trades at around 10 to 20% PE discounts relative to history. And unfortunately, the SA food producers has been a sector where investors have fallen out of love with it, given the challenges it faced in the past. It also tends to be a specific case with each company. An interesting, investing case would be Tiger Brands, where the story is premised on the basis of self-help or turnaround, given the issue that management needs to fix in the business. Some see problems, I see opportunity. And then again, in the case of ABI, we describe it as a well-oiled German machine, which just needs the fuel, i.e. the macro, to kick in to see how fast this machine can go. Overall, I think it's important to remember that just like the sun, it always rises in the morning, and that no winter lasts forever, and no spring skips its turn.